In this video, we are going to look at how to design a policy for maximum cash value. If I'm interested in a whole life insurance policy, because I've heard big banks, corporations, the ultra wealthy putting boatloads of cash here, which it is true, how do they actually design it? So when I see a policy, I see my money up front, I see it long term, I have life insurance as well, but the cash value, that's the topic of interest or the point of interest. So when I have a life insurance policy, I can pay money towards one of two areas. You, the consumer, the policyholder, can choose where your money is going to go. Two areas at the end of the day. I can pay my money toward the base premium. I'll often refer to this as the initial insurance expense. Dollars that go toward the base premium. In respect to your cash value, you will see next to nothing show up in cash value, specifically in the first year and sometimes the first and second year. Depends on the company, product, all that good stuff. The reason why is the company is going to overcharge me for the death benefit up front. So with a whole life insurance policy, premium dollars, first buy me life insurance, and then eventually, typically beginning the second or third year, I do start to see money come back to work in cash value. Those are premium dollars. PUA rider stands for paid up additions. I'll often refer to this as a cash dump-in. If I pay in the same $1,000 per year toward this component, I will see just about $1,000 show up in cash value. That is money I can access and money that begins to earn the guaranteed rate plus any dividends immediately. This is the key to maximizing the cash value on a life insurance policy. Now, it will buy me some death benefit as well. If I pay $1,000 in, I might see another $3,000 come back in actual life insurance. This depends on my age, gender, health rating, and other factors. But the point of interest is the cash value there. So the question we get all the time, and the question I had when I was a new, young insurance agent, still like to think I'm young, is how do I put zero toward my premium? When you look at bank-owned life insurance, it functions a lot like a big PUA deposit, but that's another topic. How do I put 0% of my payment toward the base premium? And the answer is, I cannot go that aggressive. How low can you go? Not quite that low. With the top companies, particularly the four major mutual companies, which are Mass Mutual, Guardian, New York Life, and Northwestern Mutual, you will find the lowest you can go is right around this 10/90 split. They all do not have that limitation. Some smaller companies allow that minimum, some let you go lower, but right around that 10/90 split, meaning if I'm paying in $10,000 per year, or I want the ability to pay in $10,000 per year, I can carry a $1,000 minimum base premium and then have the ability to add another $9,000 into PUAs per year. If I want the ability to pay in $100,000 per year, I can commit to a minimum $10,000 base premium and then have the ability to throw in another $90,000 per year. All relative, always comes down to ratio. So the first limitation, insurance company limits, how low will they allow me to go on my base premium? The second limitation is this MEC, stands for MEC, represents Modified Endowment Contract. Now the core benefits to a life insurance policy is that it is a safe, liquid, tax-free area to position money. If a life insurance policy becomes classified as a modified endowment contract, a MEC, those tax benefits are out the window. The cash value then grows tax deferred. However, anything I access, I have to pay ordinary income tax on the gains. And if I touch it prior to age 59 and a half, I have to deal with another 10% penalty tax. I don't want that. It ruins everything. So how I prevent it is every policy has what is called a MEC limit. And here's the fun part. You, the policyholder, can set this limit wherever you want with your agent or advisor. If you've worked with us, we've done this for you. How we do that is it has a direct relationship to an individual's age and total death benefit on a life insurance policy. Age and gender. Age, death benefit, and gender as well, but age and death benefit, that's the key there. So the question is here, how much do I want the ability to pay into a policy? That's where I like the flexibility feature. If I say, hey, I want the ability to put in $100,000 per year because I have money piling up in cash and I want to be able to put it somewhere that actually grows for me, I've got tax benefits and I can pull from it while it stays at work, I want to be able to pay in $100,000 per year. But I don't want to get a bill for $100 grand per year. Well, policy design, premium, I can easily commit to a $10,000 per year minimum premium and then have the ability to throw in another $90,000 per year. Minimum commitment will be a little bit higher than 10K. It might be 12 or 13K because we've got to add a term rider. So let's illustrate this. Here we've got an example of the same policy with the same insurance company, the same individual, the same out-of-pocket, same health rating, everything's the same except for the policy design. This is the fun part. On the left, we have a traditional old school whole life insurance policy. The individual is 35 years old. He's paying in $10,000 per year for a period of 20 years. What does cash value look like right off the bat? 10 goes in, all premium, cash value next to nothing right off the bat. Cumulative outlay allows us to track how much we've paid in and then how much we have in cash value over time. Full transparency there. I want to see that so I know what my actual break even is. There we go. I am positive on this policy 14 years into it. And this is based off of the non-guaranteed values. The guaranteed values take even longer. So when you hear whole life insurance is the worst area to position money if you're interested in high cash value, that's why you're buying it, it's going to take you forever to break even, or maybe you've seen something like that before, that is a result of all of our money directed toward the insurance premium. Now, with that said, as we progress on, 50-50, this means of the $10,000 payment, $5,000 is directed toward the base premium. The other $5,000 is going into PUAs. So, much better looking cash value right off the bat. Still not that great in my opinion, but I paid in $10,000. I have $5,400. By year 9, I break even, or I'm cash on cash. By year 20, I see almost a $30,000 difference between the two. Same company, same product. All we did was pull levers to put less money towards the premium and more towards PUAs to accelerate the cash value growth. The living benefit, accessing my money. Then we've got a 10/90 split. This particular company, which is one of the major mutuals, 10% is as low as they will allow us to go. So we've reduced the premium as much as possible in order to beef up the cash value. Just about 88%, 87.4 right off the bat. Breaking even, year 5. Year 20, I've cracked 300,000. I've got 307. The other examples I do not. So if a policy is properly designed, I put myself in a position very, very quickly where I can optimize the upfront and long-term cash value of a policy. The last thing I want to touch on is on the flexibility feature. So with that example, I can commit to 1,000, add more at discretion. Let's assume I've got a large amount of funds. I'm looking to pay into a policy, but I don't want to pay for 20 years. Here's an example. Individual is paying in $1 million per year for 5 years. There we go. Example on the left. We use more of an executive type product where he pays in $1 million and he's got 95% immediately. Breaking even just about year 3. Positive year 4. We can use this product with the individual putting in $10,000 per year as well. Then we've got a product geared for strong long-term performance where he's positive year 6. That takes some time. The issue with this, like here's where I have a personal issue with it. I pay in $1 million, $200,000 hit. I got 80%, almost 81% of my cash value there immediately. Can I do more with that than that money today for my business, then the stronger returns the company will credit me over time. That's the kind of question I ask myself and people we work with. If the answer is yes, someone says, hey, I put $1 million, I don't need access to even the 800, then can be a good option. But this is where it's good to see the different options. Anyway, hope you enjoyed this video in terms of how to design a policy for maximum cash value. If you have any questions, feel free to reach out anytime, and I hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.